Hey everyone, welcome back to Corporate Decoder. Today, PULM just filed their S-4 registration statement, and I am uncovering the real story behind this planned merger. Quick note, this is not financial advice, just my take on public filings for educational purposes. This merger looks like a lifeline for Pulmatrix, but it is packed with risks and the terms could be a tough pill to swallow for their existing shareholders. Alright, let's dive into what Pulmatrix Incorporated, known by its ticker PULM on the Nasdaq, is cooking up. They filed this massive S-4 document, which is essentially a registration statement for shares they plan to issue in a big merger deal with a company called Eos SENOLYTIX Incorporated. Think of it like a prospectus detailing exactly what is going down. So, what is the main event here? Pulmatrix, a biopharmaceutical company specializing in inhaled therapies, is merging with Eos SENOLYTIX, a biotech firm focusing on aging related diseases. The goal is to create a combined company that targets the emerging field of gerotherapeutics, which are medicines aimed at improving health span by tackling the root causes of aging. The deal, struck on the 26th of March 2026, involves Pulmatrix issuing about 75.2 million shares of its common stock to Eos shareholders and investors in concurrent financings. This means existing Pulmatrix shareholders are going to see their ownership stake significantly diluted. Immediately after the merger, Pulmatrix shareholders are expected to own only about 6% of the combined company according to their own estimates. That is a massive shift in ownership. Why is Pulmatrix doing this? Well, the filing paints a pretty stark picture of Pulmatrix's standalone situation. They admit they've had a history of net losses, and as of the end of 2025, they had an accumulated deficit of over $300 million. Their cash position was low, and they explicitly state that without this merger, they may have limited ability to continue operations indefinitely and might even have to consider liquidation. They also couldn't get funding or partnerships to push their own product candidates forward. So this merger isn't just an opportunity, it looks like a survival move. Now let's look at Eos. They're also a pre-revenue company focused on developing novel therapeutics targeting aging mechanisms. Their lead candidate, PDC-2105, is in preclinical development aiming for sarcopenia and sarcopenic obesity, which are conditions related to muscle loss and weakness in older adults. They've raised some capital through financings, including a $1.0 million investment in Pulmatrix, and are planning further financings. They're betting big on their mitoxel platform to deliver these aging-focused therapies. Let's talk stock price. Pulmatrix's common stock was trading at $2.12 on the 25th of March 2026, right before the deal was announced, and it had dropped to $1.7 by the 30th of June 2026. It is clear the stock hasn't been a high flyer recently, and don't expect any dividends here. Pulmatrix has never paid them and doesn't plan to. Eos, being private, has no public trading history. Now for the crucial part, the risks. The filing is packed with them and they're not sugarcoating it. There is no guarantee the merger will even happen. Delays will hurt both companies. The dilution for Pulmatrix shareholders is substantial, directly impacting their influence on the company, and the stock price could definitely take a hit. Pulmatrix itself is facing serious headwinds. They have a history of net losses, and even after the merger, the combined company expects to incur losses for the foreseeable future. They'll need more money, and there is no guarantee they'll get it, which could dilute existing shareholders even further. Their product candidates are still in development, and there is no certainty they'll ever make it to market. They're also talking about serious competition and the risk of their intellectual property not being protected. For Eos, this merger offers a path to becoming a public company, which they believe will expand access to capital compared to staying private. They're hoping for increased public market awareness for their aging focused therapies. It is a strategic move to accelerate their development. Pulmatrix's financial advisor, Gemini Valuation Services, did issue a fairness opinion, stating the exchange ratio was fair from a financial point of view to Pulmatrix's common stockholders. However, it is crucial to remember that this is just one factor the board considered. It doesn't recommend whether or how anyone should vote. Pulmatrix shareholders are being asked to vote on several key proposals. Proposal 1 is to approve the issuance of shares to Eos stockholders and to Palladium Capital Group, LLC as compensation, and to approve the change of control under Nasdaq rules. This is a big one because it is a condition for the merger to close. Proposal 2 is to approve a reverse stock split, likely to boost the stock price to meet Nasdaq listing requirements. Proposal 3 is to increase the number of authorized shares, which is a common move in these situations to allow for future financing or acquisitions. Remember, for Proposal 1, 2, and 3, a majority of the votes cast is required for approval, and these are conditions to closing the merger. So, without these, the deal is off. The board is recommending a for vote on these crucial proposals. Let's glance at the financials. For Pulmatrix, for the year ending the 31st of December 2025, revenues were zero. Research and development expenses were a tiny $38,000, highlighting their scaled back operations. General and administrative expenses were about $5.1 million. This resulted in a net loss of about $5.2 million for 2025, a significant improvement from the $9.6 million net loss in 2024. This improvement mostly came from cutting R&D and GR costs, plus the Mankind transaction loss in 2024. Looking at the balance sheet for Pulmatrix at the end of 2025, they had about $4.1 million in cash and cash equivalents, down from $9.5 million at the end of 2024. Their accumulated deficit was a whopping $302.3 million. For Eos, as of the 31st of December 2025, their cash balance was zero, and they had liabilities of $18,000. Their accumulated deficit was $329.9 million. It is clear Eos needs this merger and the associated financings to even begin operations. Now, the pro forma numbers, which show what the combined company might look like. As of the 31st of March 2026, after giving effect to the merger and financings, the combined company would have about $21.9 million in cash. This highlights how critical those concurrent financings are to getting this deal done and providing operating capital. For the 3 months ended the 31st of March 2026, the pro forma combined entity shows revenues of zero, research and development expenses of $449,000, and general and administrative expenses of $33,000, leading to a net loss of about $582,000. For the full year 2025, the pro forma net loss jumps to over $12.8 million. Mainly driven by Eos's projected R&D expenses. This underscores the significant cash burn expected post-merger to advance Eos's pipeline. The financial statements for Pulmatrix were audited by CBA CPAs PC for 2025 and Markham LLP for 2024. Eos's financials were audited by Stefano Slack LLC for 2025 and 2024. Notably, both companies are flagged for substantial doubt about their ability to continue as a going concern. This is a serious warning sign that they might not be able to meet their obligations over the next year without additional funding or the successful completion of this merger. Looking at the shareholder table for Pulmatrix as of the 30th of June 2026, RCM EOS Pipe Holdings LLC holds 100% of the Series B preferred stock, which is interesting. The executive officers and directors collectively hold less than 1% of the common stock. This shows the existing Pulmatrix shareholders are in a very small minority going into this deal. For Eos, it is a different story. As of the 30th of June 2026, Therapeutics Incorporated, which is controlled by Kevin Sloan, Eos's CEO beneficially owns 100% of Eos Class A and Class B common stock. This concentration of ownership means Dr. Sloan, through Therapeutics, will have immense control over the combined company. After the merger, Therapeutics Incorporated is expected to own about 73.2% of the combined company. RCM EOS Holdings LLC, also linked to Dr. Sloan, is expected to hold another 16.4% combined. They control over 90% of the voting power. This makes the new company a controlled company under NASDAQ rules, exempting it from certain corporate governance requirements. While they say they don't intend to rely on these exemptions now, it is a risk factor for minority shareholders who might not have the same protections. The executive officers and directors as a group will hold a sizable chunk, around 90.6%. Pulmatrix's core business has been its ISPERS technology for inhaled drugs targeting migraine and respiratory diseases. However, their pipeline has struggled, leading to the strategic review and ultimately this merger. They've essentially stopped active development on their own programs, hoping to monetize them. Eos is focused on gerotherapeutics, targeting aging mechanisms like mitochondrial dysfunction and senescent cells. Their lead candidate, PTC-2105, shows promise in preclinical studies for improving body composition and physical function in aging animals, even suggesting it counteracts the lean mass loss seen with GLP-1 drugs. However, it is still preclinical, and human data is years away. So, what are Pulmatrix shareholders voting on? First, they need to approve the share issuance to EOS shareholders, which is over 20% of outstanding shares and triggers NASDAQ rules requiring shareholder approval. Without this, the deal cannot proceed. Next, they're voting on a reverse stock split, likely a 1-for-2 to 1-for-10 ratio. This is often done to get the stock price up to meet NASDAQ's minimum bid price requirements, especially $4 to avoid delisting. But historically, reverse splits don't always guarantee a sustained stock price increase, and they can sometimes decrease liquidity. They also want to increase the authorized shares from 200 million to 250 million. This is to accommodate the new shares being issued in the merger and to have flexibility for future needs like financings and acquisitions. The risk section is incredibly long, as expected for a merger like this. Beyond the immediate merger risks, it delves into the significant financial challenges for both companies if they remain independent. For Pulmatrix, it is the history of losses and need for capital. For EOS, it is being revenue and needing substantial funding to even get to human trials. The combined company will also face volatility, potential future losses, and the challenge of raising more capital. Looking at the pro forma balance sheet as of the 31st of March 2026, you see the combined company projected to have about $21.9 million in cash and cash equivalents, boosted by the EOS financing. But remember, this is a pro forma view, and the actual numbers could differ. The accounting treatment is also interesting. It is being treated as a reverse asset acquisition, meaning EOS is essentially acquiring Pulmatrix's assets for accounting purposes. So, what is the verdict? This merger is Pulmatrix's gamble to survive, offering its existing shareholders a tiny slice of a company that is still very much in the early, risky stages of development with EOS. The dilution is significant, and the future hinges on EOS's pipeline actually delivering, which is a long shot in biotech. The market sentiment around reverse splits and controlled companies is also a major red flag. I'll be watching the NASDAQ listing closely and keeping an eye on how the new leadership navigates the path forward, especially the significant cash burn. The biggest risk I'm watching is whether the combined entity can actually achieve its ambitious goals, given the amount of capital required and the inherent uncertainties in drug development. The research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded.